at the history of the business cycle and map that against the rate of growth of consumer price index, whatever price index you choose, you find that inflation itself does not subside until a recession strikes.
Welcome everyone to Inside the Markets presented by StockPulse.com. We are more than honored to be sitting down with John Lonski. He is the president of Thru the Cycle. Thank you so much, John, for joining us today.
Well, thank you.
Everyone is talking about inflation. Can you tell us what brought about inflation and what we can expect in particular in 2022?
You know, we've gone from a situation where inflation had been non-existent during the worst months of the COVID-19 recession. But the recession, of course, was relatively brief, much shorter than some had expected, largely because of the massive amounts of fiscal and monetary stimulus that were applied to the U.S. economy. And we find that other central banks followed suit along with the Federal Reserve. So we ended up with a situation on the monetary front where the growth of highly liquid assets, or what some people call M2, that's the sum of currency, deposits, and money market funds, grew at its fastest rate since the Second World War. Now, what I'm saying here is the growth of the money supply well exceeded its fastest growth rates of the inflationary 1970s. And by itself, that was a warning of what is beginning to transpire right now. So we had this buildup of pent-up demand. People couldn't spend during the COVID-19 recession, just as they couldn't spend during the Second World War. And another similarity is that we were looking at recently the highest personal savings rates for the U.S. economy since the Second World War. And as you unleash pent-up demand in the context of record amounts of liquidity vis-a-vis GDP, you find yourself in a situation where spending is well outrunning production, and as a result, prices can only go higher.
We've seen a lot of shortage as well. I know many individuals who run businesses, various types of businesses across sectors, and they're all experiencing issues getting, whether it be chemicals or hardware, and they don't get a sense that that's going to end anytime soon. Do you think that, as some economists have predicted, that we're going to see growth moving forward?
I think we're going to see the economy continue to grow at an above average pace, maybe through the first half of 2022. Thereafter, I expect to see some slowing of economic growth as the stimulus wears off. Now, these shortages, in part, shortages can be ascribed to cutbacks in production or lower production than otherwise, resulting from pockets of COVID-19 that you have in various parts of the world. You've had COVID disrupt production in China, also interfere with the transportation of goods from China to the rest of the world. But the underlying cause of this current bout of price inflation is simply that we have so much liquidity out there that is powering this increase in spending that production cannot yet keep pace with. Getting back to my analogy with the Second World War, a lot of people forget about this, but during the first several years following World War II, the average rate of price inflation, I believe, was about 7%. And that may be a bit on the low side. So I wouldn't be shocked if, as we go through this process of getting rid of excess money supply and spending it on goods and services, or this buildup of wealth that we have realized in assets such as Bitcoin, that we will see inflation remain a problem not only in 2021, I would say 2022, and also going into 2023. You are going to see the underlying rate of inflation in the United States remain well above the Fed's target of 2%, not for 1 year, but for several years.
We've spoken inflation, supply chains. What other big stories of 2021 do you think should be on people's radars now that we're kind of coming towards the end of the year?
You know, one of the great surprises is that Treasury bond yields remain very low. I am shocked at this. It was in late August that Jerome Powell made it clear that the Fed would begin to taper or reduce its buying of Treasury bonds and mortgage-backed securities. So from that you would conclude that Treasury bond yields would move sharply higher, and likewise mortgage yields would move sharply higher. But neither has occurred yet. The latest 10-year Treasury yield, 1.54%, is still well under its 2021 high of 1.75% from March 31st. And after residing above 3% for some time, the 30-year mortgage yield is again just under 3%, recently at 2.98%. My goodness, this is confusing. The Fed makes it clear it's signaling that they are going to begin to go out of their way to slow the rate of monetary growth, and yet Treasury bond yields have not responded in a manner that might be expected. I think the fact that we continue to have low yields, low Treasury bond yields, tells me that there are market participants that are willing to pay a relatively high premium for the insurance policy that a Treasury bond provides to holders of common equity. The argument here would be that we have seen such rapid rates of growth for corporate earnings. Corporate earnings have risen to such heights that it's highly likely a year from now, the second half of 2022, we are going to be looking at year-over-year declines by corporate earnings in the context of higher interest rates. You take that together, and you'll be looking at a sell-off of equities.
Corporate earnings at highs. This is interesting. And I've heard people posit that the reason why that's so is perhaps because of less business travel. Perhaps some of these businesses are paying less on real estate as well. And do you have any inkling as to how we're seeing corporate earnings at all-time highs?
Well, we're seeing very explosive spending growth. That's why corporate earnings are so high. And, it's the growth of revenues has more than compensated for higher material costs and an emerging upturn by labor costs. Labor costs are going to be key as far as what happens to inflation moving ahead. And I strongly sense that we are going to be looking at a faster rate of growth for employee compensation going forward. Right now, the average hourly wage is up by 4.9%, and that's well above the 3 to 3.5% range that was in effect prior to the COVID-19 recession. For those worried about inflation, I've got bad news. That underlying rate of growth for wages is going to move higher. We just had at John Deere company, they had a strike. But that strike came to an end when the company agreed to provide workers with a 10% wage hike. When I talk to people that run employment agencies, I say, what type of wage hikes are people getting when they get a new job, when they move from one job to another? They told me these wage hikes are in a range of 10% to 15%. Believe me, I'm old enough to remember that the last time I heard of double-digit wage increases was in the late 1970s and early 1980s. So this should be of grave concern to those that are worried about the possibility of runaway price inflation. And I'll go a step further, is that you will come across stories where, for the first time in many years, again, since the early 1980s, we have companies that are granting salary increases that are not based on merit, not based on productivity, but simply based on trying to compensate employees for the higher cost of living.
You mentioned that you had some bad news for those who are worried about inflation. Who should not be worried about inflation right now? Or what strategies can everyday Americans apply in order to preserve their wealth in the face of inflation?
Well, one thing, you want to put yourself in a position where you're holding assets that are likely to benefit from faster price growth. And some might argue it could be cryptocurrency. Some might say that it's gold. Some might even point to equities, certain segments of the equity market, as offering protection against higher inflation. One thing you don't want to be doing is holding cash, and you don't want to hold long-term bonds where you could be hit by a sudden upturn by bond yields. It's conceivable that there is going to be some fright or sell-off that takes place in the Treasury bond market that takes that now 1.54% 10-year Treasury yield and pushes it all the way up to 3%. It wasn't that long ago, in 2018, where we briefly had the 10-year Treasury yield move above 3%. Movement from 1.5% to 3% would involve, a drastic reduction in the price of adversely affected Treasury bonds.
You mentioned the 1970s, early 80s, perhaps mid 70s to early 80s period. What other parallels do you see with that time today?
Well, the most important similarity would be, again, this liftoff by wage inflation. We also, of course, had very high energy prices during that span. And this is something worth taking into account. In the past, when we had a sharp upturn by fossil fuel prices, the U.S. government tried to encourage the increased production of fossil fuels. But that's not happening today. Instead, the U.S. government is holding the line as far as its climate change policies are concerned, and is doing nothing to encourage increased production of oil, gas, and coal, and instead is trying to perhaps discourage any additional drilling or mining for these energy resources. Lately, we've had talk that the federal government may draw down on its strategic petroleum reserve for the purpose of putting downward pressure on oil prices. The problem here is the U.S. government can only do that for so long. And what will make matters worse is that when the U.S. government tries to control the price of oil via a drawdown from its strategic petroleum reserve, companies will be further discouraged from drilling for oil and gas. And so that once the federal government can no longer draw down reserves, we are going to observe a sharp spiking of energy prices that would probably include a per gallon price for gasoline of more than $5.
Looking forward to 2022, are there any sectors of the society in which you're optimistic or particularly pessimistic?
I think, it's going to be a return to reality in 2022. One area for optimism would be the motor vehicle industry, because of how motor vehicle production has been so badly suppressed by the shortage of microchips. I mean, my goodness, we've had the annualized pace of motor vehicle sales in the United States running at about 13.5 million units. And I would consider a number of 16.8 million units as representing what is normal. So at some point in 2022, you're going to get a jump in auto sales that will also boost consumer spending as we recover from this very pronounced shortage of microchips and its adverse uh, implication for today's motor vehicle production. And in fact, that might be one of the themes that you're looking for next year, wherever you could find an industry where output has been held back by these extraordinary shortages of needed materials or labor. Perhaps that's going to be an area that's going to jump in terms of output and benefit from increased spending, and could offer a possibility for a pop in equity prices.
You're listening to Inside the Markets, presented by StockPulse.com. We're sitting down with John Lonski of Thru the Cycle. John, so are you saying that perhaps investing in some of these chip manufacturers might also be, of course, this isn't financial advice, but might be a growth sector at least?
Oh, definitely going forward. Whatever you have a shortage of can only go higher in terms of price, and that has to benefit profit margins. And you might want to take a closer look for industries that might benefit from this drive to reduce fossil fuel consumption, the electrification of transportation, be it automobiles, even trucks and whatnot. That also could be of interest, batteries and the like. Now, it could happen, however, that that this transition to a fossil fuel-free economy proves to be so costly that political forces take over and bring this transition to a temporary halt. That's conceivable. If we have energy prices go through the roof, voters complain, and your politicians are forced to backtrack on these various plans. And I would add too, so might corporations that have these ambitious plans to decarbonize. Something to not lose sight of. And in fact, I go back to the early 70s. I was around for the first Earth Day in 1970, April of 1970. They used to have popular books at that time where they had titles like Small is Beautiful. That was the beginning of this environmental movement. Well, it did well up until the recession of 1974-75, that at that time was the most severe recession since the Great Depression. And I can tell you that movement, that green movement of the early 70s was quickly abandoned as people became very concerned about price inflation and about simply having a decent job.
You are an analyst of the business cycle. Can you explain to individuals what the business cycle is and where we are in that business cycle theoretically?
Okay, we'd like to think that we're at the start of what was supposed to be a long-lived economic recovery. We came out of a recession. We had pent-up demand for consumer goods, consumer durable goods, and what we've seen of late is a realization of that pent-up demand that has helped to lift the U.S. economy out of a recession. Profits improve, the outlook for sales improves, and so we get an increase in employment, and everybody's feeling pretty good about the economy and their job prospects. Well, companies now find themselves in a position where they're more willing to pay higher wages, higher salaries. They find themselves with more pricing power than they did in the past. So what I'm sensing is that this current economic recovery is maturing very quickly. And I would not be surprised if in 2023, 2024, companies suddenly discover that they overreacted to today's shortages of labor, shortages of goods, and by that time find that their labor costs are too high and that they're stuck with excess inventories. And once they find that their inventories and production capacity and employment costs exceeds what well exceeds what is necessary to avoid a downturn in profitability or a squeezing of profit margins. They cut back on orders and they begin to lay off workers, and that pushes you towards the next economic recession.
What will that look like, the next economic recession?
I think it's going to look very similar to ones we saw in the 1970s. Basically, what occurs is companies finally find out, they discover that consumers begin to resist price hikes. The companies needed these price levels in order to justify their labor costs, what they're paying for other inputs. And once those profit margins disappear and give way to losses, companies have no other choice but to cut back on production and cut back on staff. It's going to be very similar to the recessions that followed previous bouts of rapid price inflation. And in fact, if you look at the history of the business cycle and map that against the rate of growth of consumer price index, whatever price index you choose, you find that inflation itself does not subside until a recession strikes. You know, last two times that we had a rate of CPI inflation in excess of 5.5%, one was in 2008. We know what happened then. And we also had one prior to that in 2000. Those two incidents were the overlapped recessions. So don't be surprised that if inflation continues to climb higher until companies are finally forced to end price hikes, if not resort to price discounting in order to get rid of unwanted inventories. And the accompanying cutbacks in production and staff, of course, imply the presence of a recession.
For those of us who know the history, images of long lines at gas stations come to mind. Can you describe for those of us who weren't around back then what the 1970s were like?
Oil shortages, crude oil shortages that were brought upon by the unwillingness, the refusal of OPEC to export as much oil as it had done previously to the United States, in large part because of political reasons. That was very true regarding what happened in 1974, OPEC oil embargo. And then again, we had another drop in oil imports, 79.80. That was the result of instability in Iran. And we sort of, we don't exactly have the same thing today, but what we do have, again, is a shortage of various materials, reduced supply of oil, possibly because of energy policy. And of course, this is having the effect of putting upward pressure on product prices.
Could we see bouts of stagflation again in 2022?
Well, you'll have stagflation. I mean, once you reach that point where price hikes become too burdensome for consumers, that is when you get a slowing of economic growth, slowing of consumer spending in the context of rapid price growth. Do I see that it's possible you might see signs of that late next year, 2022, but I don't think that becomes a major problem for the economy until 2023, maybe 2024, but it's going to be here prior to the presidential election of 2024.
You mentioned potential layoffs. Now, we see a shortage in the supply of workers. You tweeted this morning, younger workers are in short supply. October's meager 0.4% yearly rise by the U.S. official working age population consisted of a 3.65% advance by those 65 years and older to 57.1 million. and a negative 0.5% drop for those younger than 65 years to 204.8 million. Why are we seeing this shortage of workers generally and particularly younger workers?
That's just plain demographics, I think. The working age population measures the number of people available to the labor force. Not everybody is looking for a job or wants to work. These are people that are not in prison, they are not incapacitated for some other reason, and this is how they come up with this estimate of the working age population. And it's kind of shocking to realize that the fastest growth of the working age population applies to those over the age of 65. What you're picking up here is a long-lived decline in fertility, the number of children that we have in the United States. That's been declining for some time. And in fact, if I look at that under 65 age group, we're doing well when we look at those in prime working age relatively well between 25 and 60 and 54 years of age. That particular segment is showing no change from a year ago. We're doing poorly when we look at the size of the working age population that's aged between 15 and 19 years of age. That has shrunk by 0.8% from a year ago in October. The shrinkage of that younger segment, the youngest segment of the working age population, warns that we're going to have more problems with the potential size of the workforce moving forward. And in fact, experts who look at this, from the Federal Reserve, Congressional Budget Office, and private sector economists, believe that the long-term growth rate for the U.S. economy over the next 10 years is going to be no greater than 2% because of the continued very slow growth of the labor force that's drawn from the working age population. In fact, the long-term estimate for the labor force has it growing by maybe 0.4% annually over time, if we're lucky. And if we add to that productivity growth of 1.5%, we come up with a estimate for long-term economic growth in the U.S. of 0.4 plus 1.5 percentage point, and that is 1.9%. That gets overlooked, and this, again, has important implications not only for economic performance, but I think also for financial markets.
How does that have an effect on the potential business cycle, too?
That should lessen its amplitude, I think. We'll find that without a more rapidly growing workforce, we are not going to be able to get those big jumps in consumer spending that we observed in the past. And as a result, it's less likely that companies will find themselves with too much production capacity, excess inventories, and that should tend to lessen the amplitude of the business cycle. And it's important to note that you'll have an aging population, and you'll also have an aging workforce looking ahead. And you put the two together, if you get less in the way of household formation compared to the past, you are not going to have those young households going ahead and borrowing heavily to finance a mortgage, finance the purchase of a home, or finance all the appliances. When you're a young household, your income's going to grow, so you're more confident about spending at times in excess of what you're earning. But as the economy ages, you will see less of that, and thus, on balance, you'll find that there's going to be a lower upside for price inflation. It might well be that what we're going through right now may not be seen again unless we run into another great disruption to consumer spending from something brought on comparable to the COVID-19 pandemic.
And what effect would that have?
Oh, this long-term outlook, I think you're going to get slower growth, lower inflation. You'll get long-term profits growth, perhaps maybe no greater than 5% annually on average. You're not going to see the equity market at any time in the future repeat what it's done in the past 5 years. I think the market value of common equity grew by 17% annually on average over the latest 5 year span. That's going to be a thing of the past. So you'll have to become accustomed to smaller returns from financial assets, and that's probably also going to hold true for real assets.
We've had the honor of sitting down today on Inside the Markets presented by StockPulse.com with John Lonski. He's the president of Thru the Cycle. Thank you, John, for joining us today.
Okay, thank you very much. I appreciate the opportunity.
Where can people find your work?
They can find it. They go to LinkedIn, look down under my name, John Lonski, Thru the Cycle, type that in. It'll come up, and you could observe it there. And also, we do contribute to Twitter.
Great. Thank you, everyone, for listening.
Thank you.